Financial literacy is crucial, yet a staggering number of Americans find themselves on the ugly side of the financial system. Did you know that a mind-boggling 5.9 million households in the US have absolutely no association with traditional banks? That's right, no checking accounts, no savings accounts, and no access to crucial financial services. But the story doesn't end there. 19 million households are classified as underbanked. The implications are dire, paving the way for predatory lenders to swoop in and exploit these vulnerable individuals. What happens when unsuspecting borrowers, desperate for quick cash, become prey to unscrupulous lenders? Brace yourself as we uncover the shocking reality of their tactics. From payday loans to auto title loans and subprime mortgages, predatory lenders have mastered the art of trapping victims in a vicious cycle of debt, leaving them devastated both financially and emotionally. Discover the hidden truth and learn how to protect yourself and your loved ones from falling victim to these financial predators. Hi, allow me to welcome you to another video of Finance Sense, where we cover all the latest trends in the financial markets and the economy. Make sure to leave a like, subscribe if you're new to our channel, and turn on the notification bell to keep posted. With that being said, let's start. Picture yourself needing some quick cash as much as possible. You go into a bank, speak with the manager, hand over some paperwork, fill out some forms, and leave with the cash you came for. This seamless procedure shows how most people obtain loans, demonstrating the effectiveness of our modern financial system. While some fortunate individuals perceive the system as flawless, a closer examination reveals that not everyone enjoys easy access to credit cards, mortgages, car loans, and other forms of credit. There exists a concealed aspect of our economy, unbeknownst to many. Countless individuals are completely excluded from the financial system, lacking access to banks, credit unions, and financial institutions. Consequently, these forgotten individuals are left with limited alternatives and are often compelled to engage with predatory lenders, unscrupulous individuals who exploit their vulnerability through exorbitant interest rates, fees, and occasionally the threat of violence to recover their money. The distressing narratives of these individuals unveil a troubling and disconcerting truth about the financial system. This represents the ugly side of the economy: predatory lenders. According to reports, approximately 5.9 million households in the United States have no association with traditional banks, which means that nobody in those households possesses a checking account or savings account, or even gets their paychecks cashed at a bank. These individuals are referred to as the unbanked, comprising nearly 5% of the US population. Additionally, there are the underbanked, accounting for about 14% of the population, or roughly 19 million households. Both groups are prime targets for predatory lenders who deceive and manipulate borrowers, taking advantage of their limited financial knowledge and steering them toward loans they cannot afford. As stated by Investopedia, a loan shark is an example of a predatory lender. It is an individual who lends money at exorbitantly high interest rates and may even resort to violence if they aren't repaid. However, upon closer examination, many seemingly trustworthy businesses and individuals, including banks, mortgage brokers, finance companies, lawyers, and real estate construction companies, are also involved in predatory lending. In 2011 and 2012, the Department of Justice arrived at settlements amounting to $335 million and $175 million to resolve allegations of discriminatory lending practices by Countrywide Financial Corporation and Wells Fargo. Essentially, money lenders employ unfair, deceptive, and crafty methods to persuade struggling borrowers to accept loans from them. For the most part, it is not the loans themselves, but rather the associated behaviors that constitute predatory lending. For instance, one form of predatory lending is payday loans. Payday loans, also referred to as check advance or cash advance loans, are small short-term loans typically below $500. They are intended to provide temporary financial assistance until your next paycheck arrives. When you receive your paycheck, you must repay the loan in full immediately. Failure to do so grants the lender the legal ability to access and withdraw the funds from your bank account without informing or seeking your consent. Payday loans are popular and easily accessible. All you have to provide the lender is proof of income, like a payslip. This accessibility makes them highly appealing to borrowers who possess few assets, have poor credit, or lack credit history altogether. In fact, these loans are so widely utilized that a 2021 survey conducted by Pew found that 12 million Americans rely on payday loans every year, taking out an average of $375. These funds are often used to cover monthly bills, rent, car repairs, and other unexpected needs. Another example of predatory lending is bait and switch. Car loans and short-term loans are legitimate forms of borrowing. However, bait and switch happens when a lender provides you a loan without telling you that your interest rate will increase after the initial period. The crucial point to note is that the deceit involved makes it predatory rather than the specific type of loan. Though convenient in the short term, these loans frequently cause much more severe issues in the future. The interest paid on these loans can quickly spiral out of control, costing borrowers more than they originally borrowed. For instance, on average, individuals who resort to payday loans pay $520 in fees to borrow $375, resulting in an extraordinarily high interest rate of 138%. On the other hand, certain payday lending companies charge outrageous interest rates of $30 for every $100 borrowed over a period of 2 weeks. This translates to an exorbitant annual interest rate between 260% and 785%. Because you authorized the transaction by providing your account details, the lenders can legally deduct the funds from your account. If you want to borrow money from one of these lenders, you'll have to comply with their requests, which include giving them your bank account details and granting them authorization to electronically withdraw funds from your account. If you fail to repay a payday loan by its due date, the lender will automatically deduct it from your bank account. They'll either take the money from your checking account or cash your check. If you'd want to renegotiate the terms of your loan, you can do so by visiting the loan office and renewing your loan with additional charges. Many borrowers find themselves doing this repeatedly, incurring additional fees with each renewal. This is the norm and how payday lenders primarily generate their profits. A study conducted by the Consumer Financial Protection Bureau in 2021 discovered that over 60% of individuals who obtained payday loans still had outstanding balances 6 months later, indicating the persistence of debt among borrowers. Now, envision yourself in the process of searching for a new home. You come across the perfect property, but unfortunately, you cannot afford it. Typically, in such a situation, you would consider obtaining a mortgage and gradually paying off the loan. However, you face an obstacle as the bank rejects your mortgage application, citing reasons such as poor credit score, insufficient savings, or substantial debt. You confide your despair to a close friend, and they offer to support you. A few days later, a lender starts calling and offering to help you with your circumstances and grant you the desired house loan. They entice you with lenient terms and downplay the payback period as long as you have some equity in the house. However, the story doesn't end there. Blinded by your desperation to own a home, you take the bait and complete all the necessary loan paperwork, unaware that the loan is structured in a way that allows the lender to take advantage of your equity in the house. Even if your income is low and you don't meet the qualifications for the loan, the lender urges you to falsify information on the loan application to secure approval. But here's the gut-wrenching part. You realize that you can't afford the monthly payments, the interest rates are sky high, and the repayment period is alarmingly short. Eventually, you find yourself unable to make the payments and default on the loan, resulting in the loss of your home and facing foreclosure. The most devastating aspect is that the lender doesn't bear significant losses. Instead, they sell the home during foreclosure and make more money than they initially lent you. This fraudulent practice is known as equity stripping. It involves taking ownership of your house to make a profit at your expense. It is a deeply disheartening situation that countless Americans have found themselves in. Additionally, be wary of other predatory lending practices such as loan flipping, loan packing, hidden balloon payments, reverse redlining, and mandatory arbitration. Predatory loans can take various forms, often characterized by their sly and inconspicuous nature. However, if you encounter any of these 3 aspects, exercise caution as you might become their next target. First, the lenders may approve your loan application simply based on the value of your assets while giving less weight to the one thing that should be most important, your capacity to repay the loan. Second, they will pressure you into refinancing your debts so that they can collect more fees. Lastly, they may try to conceal specific loan details from you, dismissing them as mere technical terms. Today, the most common loans used to trap borrowers are payday loans, subprime mortgages, and auto title loans. People with poor credit histories and high tendency for loan default typically qualify for subprime mortgages. This loan comes with exorbitant interest and fees, far more than the rates offered for prime loans, which are reserved for customers with the best credit. Equifax, a credit reporting agency, defines subprime borrowers as those with credit ratings below 650, representing a significant risk for financial institutions. Credit scores typically lie between 300 and 850, while some FICO score calculators go up to 900. Moreover, while there is no universally accepted cutoff for a bad credit score, those with scores below 650 are often viewed as a high financial risk. If you fall into the category of having bad credit, you become a prime target for lenders offering loans with unfavorable terms and high interest rates. It is unlikely that you will be offered the best loans with the lowest rates. Meanwhile, auto title loans are a type of single payment loan determined based on your car's value. Like other predatory loans, auto title loans impose high interest rates, and as collateral, you are required to surrender your car's title and an additional set of keys. If you cannot repay the loan, your car can be repossessed. The consequences of this extend beyond financial implications and can significantly disrupt your life. Without a car, commuting to work, performing daily tasks, and taking care of your children become considerably challenging. If payday and auto title loans are widely recognized as detrimental, why do many Americans continue to resort to them? The answer lies in the financial circumstances of many individuals and families who utilize these loans. Often, they do not have sufficient funds to cover their monthly expenses and face unexpected emergencies. Research shows that payday loans are more commonly used by women and individuals from marginalized communities. In fact, over half of payday loan borrowers are women, and African Americans are twice as likely to utilize these loans compared to other demographic groups. This trend is closely tied to income and wealth disparities, as well as the geographical distribution of payday loan stores, which are often concentrated in African American and Latino communities. These circumstances are influenced by various factors that impact individuals' financial situations. One such factor is low wages, where salaries have not experienced substantial growth over time, and any increases are offset by rising costs attributed to inflation. Additionally, the widening gap between the rich and the poor exacerbates the financial challenges many individuals face, contributing to their reliance on payday and auto title loans. Hi, it looks like you've reached the end of this video. Thank you for watching this far. I hope you have learned something substantial about predatory lending and how you can protect yourself from such deceitful practices. Please subscribe and give a like if you enjoyed it, and comment your thoughts in the comment section. This is Finance Sense, helping you keep up with all the latest trends in the financial markets and the economy. See you around!